Hey there, everyone. Dave Keller here with Market Misbehavior. Today, we're going to tease out the technical configurations of 7 different Dividend Aristocrats. What is a Dividend Aristocrat? Well, in a few moments, we're going to use the Seeking Alpha platform to tease out that particular group of stocks, what they represent, why they could potentially provide that 1-2 punch of strong price action and strong dividend component or an income component. All along the way, we're going to use the Seeking Alpha platform. They are doing a special right now on Seeking Alpha Premium. If you use my link, marketmisbehavior.com/Seeking Alpha, you can find all the information about Seeking Alpha Premium. Essentially, they talk about investing with confidence, investing with quant. We're going to use the dividend component of their website, which you can actually find under the market data section. Now, the market data section is an area of the website that I use pretty regularly, and it's a great way of just sort of understanding the general configuration of this market, right? Thinking about broad asset class movements, things like major global equity indexes, commodities, currencies, cryptocurrencies, earnings calendar, kind of everything you would need to navigate the current market environment. But today I was sort of scanning around for ideas, so I thought I would take a look at Seeking Alpha's market data section, and particularly the Dividend Aristocrats section. Now you can see a little explanation here. Basically what this means, they're looking at S&P 500 members that have increased their dividends for at least 25 consecutive years. So that means immediately we are filtering out a lot of the stuff, a lot of things that have random dividends or something like that, maybe inconsistent dividends. The idea with the Dividend Aristocrat, it's a consistent dividend payer, right? Because one thing we've learned in the last 5 to 8 years, particularly kind of in the post-COVID era, dividends are not permanent, and companies can't adjust and even take away their dividends as needed. So we're looking for companies that have demonstrated a commitment to the income side of the equity argument. Because remember, stocks gain value for you as an investor in 2 general ways. Number one, capital appreciation. The price goes up, and that's where we spend a lot of our time as technical analysts, but also the income component, the dividend component, which is the company giving money back to shareholders in the form of a quarterly or monthly dividend or whatever it might be. So when you bring up the Dividend Aristocrats, it's going to automatically sort in descending order by the forward dividend yields. This is basically looking at the dividends they've been paying over time, sort of incorporating any sort of general increase in dividends that might be expected over the next 12 months. And basically saying for a stock like Hormel with a forward dividend yield around 5.5%, what that means is basically you buy Hormel today, and you, over the next 12 months, should expect to get about 5.5% of today's payout back in the form of a dividend. Now, it's a forward estimate, right? So it's an estimated dividend. It's not a guarantee, but based on the consistency, we can have a reasonable expectation. That's about what we might get. Now, remember, a dividend yield is calculated as the quarterly dividend, or the annual dividend, in this case, the 12 months of dividend payouts, relative to the stock price as a percentage of the stock price. So remember that this 5.5% dividend yield is not static, it's actually dynamic. So if the price of the stock goes up or down, the dividend yield is going to fluctuate as well. As you look to the right, you can see sort of the returns on Hormel in particular. Over the last month, it's down 7.6%. Year to date, the stock's down about 10%. This is as the S&P and the NASDAQ, of course, are at new highs. So the forward dividend yield probably looked a lot lower, but as the price is starting to come down, that 12 months of dividends is higher as a percentage of the current stock price. So those numbers could fluctuate every day as you run this scan. But again, this is looking for a group of companies that are generally doing pretty well. One of the things I like to look at with this particular group is sort it over a shorter term time frame. So here we're actually sorting it based on the 1 month returns, just to focus on which of these high dividend payers, consistent and dividend payers, have actually experienced some strong price action recently. And the idea is we're looking for companies that actually are consistent dividend payers, but also have strong performance characteristics here, which means most likely the charts are going to start to look pretty good. Now, as a premium member, we can do a lot more sophisticated scans like this, incorporating dividend and consistent dividend payouts along with other things. So they actually have quant models, as you can see to the right, looking at things like dividend growth and dividend safety, right? Is it a reasonable expectation this dividend isn't going to go away? Then they also have a quant rating that combines, all sorts of things, valuation, momentum, etc., to give you an overall picture. So I also like to sort those tables based on that data as well, which can help me focus on sort of the companies demonstrating some of the stronger characteristics. All right, so I've actually hand-selected 7 charts that appear on this one and also the Dividend Champions list, just looking for stocks with some good, consistent dividend payouts that have some interesting technical configurations to review. Let's start with the chart of Caterpillar, and when we look at CAT, these first 2 charts are kind of nice, consistent uptrends, right? So besides the dividend component that's fairly consistent, what stands out about these first 2 charts is that they're in an accumulation phase, right? One of the things that I like to look for are stocks that are in a consistent pattern of higher highs and higher lows, stocks that are above their moving averages, stocks showing generally positive momentum, stocks showing strong relative strength, and that's the bottom panel, looking at the performance, the relative performance of Caterpillar versus the S&P 500. Here we can actually see that for the last 12 months, Caterpillar has been pretty consistently outperforming the S&P 500. It's been generating that outperformance because of a very consistent uptrend phase with a series of kind of pullbacks to the 50-day moving average. Every one of those has ended up resulting in an upward swing, most recently at the beginning of April, where we had a gap higher and a continuation moving further. This is actually an earnings name this week, and so the assumption here is that we're going to see earnings that provides further opportunity for appreciation in the stock price. But for now, pretty consistent uptrend. What strikes me about the chart of Caterpillar, by the way, is we're just recently overbought. We came out of that overbought range as there's a bit of a tactical pullback. So I'm wondering if there's a bit of a tactical pullback going into this week's earnings. Does that provide a catalyst for further upside? If we do get any sort of pullback, I'm immediately looking at the 50-day moving average because that's served as pretty decent support recently. So a pullback to the 50-day moving average could present a good opportunity. Also note on those previous pullbacks to the 50-day moving average, the RSI held the 40 level. And that's one of those important factors to watch for in a consistent uptrend. Are pullbacks holding RSI 40? So if we get any negative news, let's make sure we make a higher low. Ideally, we hold the 50-day moving average, and ideally the RSI holds above 40. If all those things are true over the next week, Caterpillar most likely remains a pretty solid chart. Another one on this list of the dividend, strong dividend stocks from Seeking Alpha, we found Casey's General Stores. Casey's is a chart, it's a stock within the consumer staples sector, so it actually looks a lot better than the average consumer staples stock, but you can see the chart is very similar to the chart of Caterpillar, right? This is a stock making higher highs and higher lows. Now, the dividend yield looks pretty low, and that's because the price has gone up so much. So it's still paying a consistent dividend. It's just the price action has been so strong over the last 12 to 18 months that dividend yield, that forward yield, is looking smaller and smaller because stock keeps gaining in price action. However, let's remember the fact that we are still in an accumulation phase of higher highs and higher lows. We're seeing the price above upward sloping moving averages. The RSI recently overbought, but over the last year to date, basically the RSI hasn't been below 50 for much at all. And because of the strong trend, because of the strong configuration of the moving averages, because of the strong momentum, the stock is outperforming year to date in a pretty decent capacity. So one of the things we find when we start to sort by 1-month returns or like year-to-date returns is starting to surface some of those names like Caterpillar, which have shown quite a bit of strength. So now we're looking for stocks that have consistent dividend payouts but also have strong price action. The next 2 charts may be a little bit different. Next one we're going to look at is Franklin Resources. We can see a forward dividend yield, an estimated yield of about 4.5%. And we can see it's obviously had some pretty good returns here. It's actually done quite well. And just this week, we're following through after reporting earnings. They actually reported on Tuesday of this week, which ended up being pretty positive. So we had a nice breakout above resistance. So while names like Caterpillar and Casey are more inconsistent uptrends, Franklin Resources actually was in a significant pullback, right? This was January, February had a short-term peak. Look at how in the month of March, we broke all the moving averages, right? We broke the 21-day, we broke the 50-day, and then we broke the 200-day. So this gap back above the 200-day moving average was pretty meaningful. Look at, we saw a very similar thing, similar pattern back here in November of last year. We broke below the 200-day moving average for about a week. Then we finally broke higher and then broke above the 50-day. The RSI pushed above 60. That was a sign of a strong upward phase. Compare that to what we saw recently here. We broke below the 200-day moving average here for a couple weeks. Then we broke back above it. We followed through above the 50-day moving average. The RSI pushed above 60. So by the second week in April, this looks like a pretty good chart. And that was a nice move higher going into earnings just this week. And we've had a nice positive breakout above $28 a share. So the good news is, even with the stock going up, from the mid-teens to almost 30 over the last 12 months, the forward yield is still pretty elevated because, again, consistent dividend payer, even with the strong price action, pretty good opportunity potentially to have an income component as well. Nucor is one of the other names that was on that Dividend Aristocrats page for consistency. Again, the dividend yield's a little low right now because we've had such a significant rise in the stock price. However, still represents consistency, which is what we're talking about in particular. Similar to the chart of Franklin Resources, I like this breakout to new highs. One of the things I often look for are stocks making new 3-month highs, just as a validation that we have been in some sort of pullback, but now we're resolving that to the upside. Post breakout, I love the follow through that we've experienced here on Nucor. As with many steel companies, the RSI is very high. You can see the RSI is actually sitting just above 80 right now, and that often means kind of two different things. Number one, the primary trend is still quite strong. Number two, we're probably going to get some sort of short-term pullback if and when the RSI comes out of that overbought region. And again, to clarify, right, this fact that the RSI is this high represents strong upside momentum. Usually when you have the RSI above 80, if we do get a pullback, there's often at least one more move higher. Because the momentum has been so strong, we probably still have further upside potential. Given this breakout in price, which is propelling the stock back above all the moving averages, given the extreme overbought condition, it really is driving strong performance. So this is one of those stocks where I'd probably wait for some sort of tactical pullback. Maybe the 21-day EMA would be an interesting opportunity to get back in. But again, because of the consistent dividend component, that might give me some peace of mind that there could be a long-term opportunity there as well. All right, the next two charts are a little different. These are names a little bit further down the list when I was looking for 1 month returns, or they're further down the list of dividend pairs, but have had some pretty good short-term returns. And so two charts I wanted to highlight are West Pharmaceuticals and then Wiley & Sons. That was on the Dividend Champions list, which is the next tab over there. I think these are just actionable charts to talk about, some kind of interesting ones. Again, this is more of a low dividend payer, but I like the setup as an example of what we call a gap and fail. This is not an ideal long situation, I would say, based on the technical setup at this point for me, but it has a setup that I'm kind of watching, and let me explain. When you have a stock that gaps higher, and this stock actually reported earnings last week, and we can see the gap here, right? Overnight, it gapped from around 275 up to 308 from one day to the next, and that was around their quarterly earnings report. That day, it traded up to around 320, but that 320 level has been the high watermark. What's happened since then is over the last week, the stock has started to drift lower. So this is what I call a gap and fail pattern, or a jump and dump. We jumped higher on earnings, but instead of investors super optimistic, willing to pay more and more for the stock because of the earnings potential looking forward for West Pharmaceuticals, we're actually seeing sellers come in, all right? So we gapped higher, and then investors use that as an opportunity to unload positions. And so that selling pressure is causing the price to pull back quite a bit. We're looking at this range because now we're in the middle of this gap, which was from around 280 to around 302, 303, we'll call it. That was that gap that was created around the earnings release. We're now coming back to the middle of that gap, which is lining pretty well with the resistance that we saw in the fourth quarter of last year. The 21-day moving average is all the way down here, right around that swing high in April. So I'd say pull back to around 280. this chart may start to look kind of interesting, because even though we've failed, we've now pulled back to the degree that if this is going to be a long-term success story, that's about as far as I'd be happy watching the price go. And still think of it as a constructive chart. So maybe that's where I would take a little bit of a nibble to buy on that short-term weakness and maybe ride the next leg higher. However, for now, I'm seeing post-earnings weakness. And friendly reminder, I mean, with the tools on Seeking Alpha, we also have the ability to look at an earnings calendar. So that's a really good way to just stay on top of who's reporting, and if there's any basic details we can evaluate about what's happening. Of course, this week we've got 5 of the Magnificent Seven reporting earnings this week. So keep an eye on that earnings calendar. But then again, we can use charts to reflect on what's happening to the price going into earnings, but even more importantly, after earnings. And a pattern like this, where you have the gap and then fail, or the jump and dump, as I like to call it, usually not an ideal setup, because that means there's weakness after that gap higher. Look for a higher low, ideally around the 21-day EMA. That's where I might think of it as a potential opportunity. John Wiley & Sons, ticker WLY, is sort of a mid-cap name, a decent dividend yield, even with the recent run in the stock price. I would say this one is actually a little more constructive. This is actually, they had a nice gap higher in March. That was around their earnings release and earnings mark in early March. You can see that the stock was sort of consolidating in the 28 to 31 range for quite some time. Then we gapped higher in March. RSI pushed right up to 80. That was 2 big up days. We then consolidated after breaking above the 200-day. Then a nice, healthy uptrend resumed. So this is one paying a dividend that's fairly consistent and fairly decent amount. Looking for a higher low, which may be what we're setting up for here. And again, the 21-day exponential moving average is one of those levels that I like to think of as a short-term, kind of an initial stop. Not that I would completely change my positioning on a break of the 21-day EMA, but it does tell me, all right, maybe this is starting to be a more significant pullback that I need to think more deeply about. And if I missed a trade, a pullback to the 21-day EMA will often be an opportunity maybe to ride the next leg higher. So those are 2 stocks, I think, with some important technical configurations. The question is whether they hold the recent breakout, or in the case of West, can it actually resume the uptrend? Final stock that I found digging into the Seeking Alpha platform this morning, FactSet Research Systems. This is a very different chart than the other 6 that I show, but I like to highlight some names. If you're more of a bottom feeder, more of a bottom picker, looking for stocks that have been beaten down and now starting to show some signs of improvement, let's celebrate the fact that FDS made a new 52-week low in February after a long uptrend and a big breakdown in January. From there, though, we've started to regain our ground. We've made a couple higher lows. We broke above the 50-day moving average and now have continued higher. And just in the last week, we've bounced off the 21-day exponential moving average. Now, with something like this, I think about the difference between a trade and an investment. For me, the big bullish signal would be a break above the 200-day moving average. That's one of those basic structural components that I use to evaluate whether a stock is in a constructive pattern or a negative pattern. So the fact that it's still below the 200-day, it's not ideal. However, if we see further appreciation, if we keep making a pattern of higher highs and higher lows, it's possible. So on this kind of chart, I'd be looking for confirmation in the form of a break above the 200-day moving average. I'd also like the RSI to remain above 50 during this advance, which would mean there aren't really any significant drawdowns that are shaking some people off the long side. And if that happens, I would expect the relative performance to start to improve. Again, the good news with FactSet is that it's a pretty consistent dividend payer. Now the question is, will the price action improve? Because if it's a good dividend payer, but the stock price is doing this, it's kind of not great, right? Because I'm losing value on the core position. I'm just gaining a dividend, but that's not supplementing. That's not compensating for the fact that the stock price is down so much. So even if company pays a good dividend, I still don't want to own stocks where the primary trend is lower. So is this enough to make the primary trend higher? We saw a false breakout in December of last year and January of this year. It didn't quite get above that October swing high. So now the question is, can we get above these March and April highs? That would be an initial bullish sign for me. Follow through above the 200-day would be ideal. So there you go. That's a run through 7 different charts, all found using the Seeking Alpha platform, helping me think about consistent dividend payers and then just looking at the charts. And this is how I set up my process quite some time, using Seeking Alpha, a platform like this, to really think about which stocks have certain configurations and using the dividend data that they feature, and also some of the premium features like their quant ratings. Quantitative ratings like dividend safety I find are really helpful, because if you just focus on the dividend yield, you're missing a key point of the dividend, which is dividend consistency. That's why looking for Dividend Aristocrats, what they call dividend champions, are helpful, because that gives you companies that are consistent payers of a dividend. So by using the quant rating and using the dividend ratings that they provide, I think you really have the opportunity to look for that healthy balance between strong performance and price and strong dividend component. As a reminder, the way that we use the Seeking Alpha platform is really only in its best, giving its best results when we use the premium version. You can find more information at marketmisbehavior.com/Seeking Alpha. I've reviewed their quant model in great detail, and I'm a huge fan of it. They also have a lot of other great features, which you will find information of about if you go to that website. So again, marketmisbehavior.com/Seeking Alpha. My name's Dave Keller with Market Misbehavior. Thanks so much for joining me here today. And remember, it's always a good time to own good charts. Take care, folks.